car loans and the challenges that are presented when we utter those immortal words, I'd be interested in buying that car. There are a few things to consider, ideally before you go out car shopping, and certainly before you take the loan out. Firstly, what's your budget? And what deposit are you thinking about putting down? You might be the car. Do I want to use somebody else's money or use my own? Maybe I can use that money elsewhere. Secondly, you might decide how you want to borrow and pay for that loan. The temptation is obviously just to, look, I just want, Chris, the lowest number, the smallest number. Is that asking too much? I just don't want to have any more cost than I need to. But that cost clearly depends on a number of factors, not least of which is how long you're going to keep the car. So you've probably heard about these personal contract purchase plans, PCPs, but I'm not quite sure what they're about and how they differ from hire purchase plans. This is what we're going to deal with in this blog. So PCPs are a special type of hire purchase plan, originally going back in time were popular with businesses that didn't want to commit all their cash into the purchase of the whole car on their fleets, especially if they had large car fleets. Private citizens, you and I, have come to realise that it's actually quite useful to use someone else's money to buy or part buy some of the cars that we want to drive around in. Typically, these plans are becoming more of a rental scheme, as you never actually own the car, although you are obviously responsible for it. So, as a long-term rental agreement, you don't really have an asset at the end of that term, but you would have the opportunity to buy the car for a balancing sum after your 3 or 4 year period, or simply hand the keys back and walk away. So, how do they work? Well, the advantage of a PCP is that you're only paying for part of the full value of the car, so your headline monthly payment is likely to be significantly lower than you would otherwise pay. The finance company will estimate the depreciation in the price of your car by the end of the agreement term you've agreed, largely driven by its condition and mileage. And then you would just finance that depreciation sum based upon their interest tables. And at the end of the agreement, you'd then have, as I say, this opportunity to buy the car or walk away. Critically, these plans usually have mileage limits with significant penalties for going over, say, a 10,000 mile annual limit. So while a few miles over may not be a problem, but if you're a higher mileage driver, then at 10p a mile or 8p a mile for 2,000 or 3,000 miles, that can be a significant payment that you could suddenly get hit with. The difference with a standard hire purchase agreement is that you're hiring and purchasing the whole car. So you don't actually have that sum at the end to worry about. It's in fact irrelevant. And in fact, the minimum guaranteed future value no longer exists. It's also irrelevant. As a result, the monthly payments are likely to be rather higher because you're financing the whole of the car. But that's the whole point. At the end of the term, you would own the whole car. So, if you are likely to want to keep that car for a longer period of time, then HP agreements tend to make more sense. However, if you know that you're likely to want to keep changing your car every 3 to 4 years, and consider it therefore more a car rental scheme, a little bit like a phone really, then the question becomes, how much depreciation do I want to pay for? At that point, the other question to then consider is the interest rate on the loans that you are being offered by the finance company at the garage, or externally even. And it is important to ensure that you're comparing like with like, so APR to APR. And you will hear terms like flat rate and APR, and the difference between those two is the subject of a separate blog that I put together, along with a calculator which is designed to help you to work out what your likely payments would be on either of those loans. Hopefully you'll find that helpful. So back to PCPs though, if you want to be more precise in your understanding of them, then it does work out if you need to pay a little bit more attention to the role of depreciation on your chosen car, which of course significantly affects the amount that you would need to borrow. To give you a rough guide of this, cars generally depreciate by about 50% over 3 years, and obviously the more expensive the car, then the more significant the difference gets between something that holds 45% of its value after 3 years to something that holds 55% of its value. This is again something that we can talk about more in another blog, but certainly worth paying attention to. These plans have become much more attractive over the recent years, and they seem to be offering you access to more car for your money, and obviously you have a greater opportunity to use your money elsewhere or mitigate your borrowing so your overall monthly payments are lower. And clearly you do need to look at this in the balance of your whole spend rather than committing all your money behind your lovely car. I hope you found this helpful anyway, and I look forward to chatting to you again. And if you want to find out more tips and thoughts on personal finance that are going through my brain, hopefully they'll be helpful to you. And you can find me at moneycoachuk.co.uk or on Twitter at moneycoach_UK. Good luck and prepare your plan.